Today, we will talk about interpolation and how investors and analysts use it. Interpolation is a statistical method by which related known values are used to estimate an unknown value or set of values. In investing, interpolation is used to estimate prices or the potential yield of a security. Interpolation is achieved by using other established values that are located in sequence with the unknown value. If there is a generally consistent trend across a set of data points, one can reasonably estimate the value of the set at points that haven't been explicitly calculated. Investors and stock analysts frequently create a line chart with interpolated data points. These charts help them visualize the changes in the price of securities and are an important part of technical analysis. Interpolation can be compared with extrapolation, which estimates unknown values that extend beyond the known data, rather than values that fall in between known data points. Investors use interpolation to create new estimated data points between known data points on a chart, representing a security's price action and volume. There are several formal kinds of interpolation, including linear interpolation, polynomial interpolation, and piecewise constant interpolation. Financial analysts use an interpolated yield curve to plot a graph representing the yields of recently issued U.S. Treasury bonds or notes of a specific maturity. This type of interpolation helps analysts gain insight into where the bond markets and the economy might be headed in the future. The easiest and most prevalent kind of interpolation is a linear interpolation. This type of interpolation is useful if one is trying to estimate the value of a security or interest rate for a point at which there is no data. Let's assume, for example, we're tracking a security price over a period of time. We'll call the line on which the value of the security is tracked the function f. We would plot the current price of the stock over a series of points representing moments in time. So if we record f, x, for August, October, and December, those points would be mathematically represented as x August, x October, and x dec, or x1, x3, and x5. For a number of reasons, we might want to know the value of the security during September, a month for which we don't have any data. We could use a linear interpolation algorithm to estimate the value of f, x, at plot point xep, or x2 that appears within the existing data range. One of the biggest criticisms of interpolation is that although it's a fairly simple methodology that's been around for eons, it lacks precision. Most charts representing a stock's history are in fact widely interpolated. Linear regression is used to make the curves that approximately represent the price variations of a security. Even if a chart measuring a stock over a year included data points for every day of the year, one could never say with complete confidence where a stock will have been valued at a specific moment in time. In technical analysis, there are two main types of interpolation: linear interpolation and exponential interpolation. Linear interpolation calculates the average of two adjacent data points by drawing a straight line between them. Exponential interpolation, on the other hand, calculates the average of two adjacent data points by fitting an exponential curve to them. Interpolation estimates unknown values that fall between two or more known data points, filling in the blanks. Extrapolation instead extends known data points outward. Interpolation is a mathematical technique to estimate the values of unknown data points that fall in between existing, known data points, helping to fill in the blanks and provide a more complete picture of past price action. One of the criticisms of using interpolation in investment analysis is that it lacks precision and does not always accurately reflect the volatility of publicly traded stocks. Here are three key takeaways. 1. Interpolation is a simple mathematical method investors use to estimate an unknown price or potential yield of a security or asset by using related known values. 2. By using a consistent trend across a set of data points, investors can estimate unknown values and plot these values on charts representing a stock's price movement over time. 3. One of the criticisms of using interpolation in investment analysis is that it lacks precision and does not always accurately reflect the volatility of publicly traded stocks. Hope this would help. Thanks for watching.